All right, we're getting to the heart of accounting, and today we're facing what's called the accounting equation. So assets should equal liabilities plus owner's equity. And we're talking about proprietorship so that there's only one owner up here. So that's an underlying framework for recording and summarizing all economic events that we will have in our business. Assets could be claimed by either creditors, so we're talking about liabilities, and give me a second. In the next couple of slides I'll explain what those terms are. And then if the business is liquidated, claims of creditors must be paid, so liabilities must be paid before claims of owners could be faced. Let's take a definition of assets. Assets are resources that the business owns, or it is also future benefits, future probable benefits. What are some of the examples of those? Cash, you could have supplies, you could have equipment. Another ones that I would like for you to write out is accounts receivable. What are those? I can sell or provide services on account. What does it mean? If I have very good relationship with another business or with another owner, I can provide services and bill them later for the services. So for example, college could be billing you, assuming you will be paying. No cash has been received, but I could record accounts receivable because it's my cash to be, cash that I will be receiving. Another item that I would like to take a look at is supplies versus equipment versus inventory. So what are those? Let's pick a business. For example, we've got a bakery. So what are the supplies for a bakery? Supplies will be something that will not be consumed right away, but could be used in business several times or reused, and they're usually smaller in value. So for example, I could have bowls, I could have whisk, I could have a rolling pin, etc. As opposed to equipment. Equipment is usually larger and over a certain threshold, monetary threshold, maybe over $500 or $1,000, depending how large the corporation is or a proprietorship is. So for example, $500 for me as a proprietor is expensive, so I will record it as an equipment. For Caterpillar, that's peanuts, so they might say a threshold for them will be $5,000 to record it as equipment. And it has to be used for several years. And one more is inventory. So I'm going to write it out for you. Inventory. What is inventory? It's a little hard to write. Inventory. Please remember, inventory is for sale. So I created product and it must be for sale. So for example, think about that bakery. What is some of the inventory? Well, eggs is actually inventory. It's raw material inventory because you will be using it in business. And bake something with that. Salt, pepper, sugar, flour, etc. Then half-baked donuts or dough. That's still inventory. That's work in process. And then the last part of inventory could be finished goods. So if I look at the cookies or donuts, that's my inventory, and that's for sale. One more unusual one, so sometimes students get confused with that one. You could have investment. Okay, what is an investment? So for investment is an asset that I purchased with an intention to hold in hopes that it will increase in value and then I can sell it. So it's not for sale right away like inventory, and I'm going to hold it and sell it sometime later. So for example, a large example for you guys. I could have a car in a dealership, and it could be my equipment. If it is a van that gives my customers rides, they drop like a loaner. They drop off their vehicle and they borrowed my vehicle and they took it to work. So that's equipment. Okay? Or it could be inventory. Why? Well, if I sell a whole bunch of cars out on the lot, that's my inventory. Or it could be an investment. How come? I have a very rare Mustang, maybe 30 years old, and I put it inside the dealership with a large sign, do not climb, do not touch, do not sneeze nearby. That's my investment. Maybe sometime down the road I will resell it. Let's take a look at the next. You will have liabilities. What are liabilities? Liabilities are claims against assets or your debts and obligations. By who? By creditors. So claims of creditors. Creditor is a party to whom money is owed. And here are some examples of various liabilities that you would have. If you look close, you will see a nice pattern. They typically have the word payable in their title. Accounts payable, notes payable, salaries and wages payable, mortgage payable. So if you have the word payable, you can assume it must be a liability. There's only one liability that we'll see in the next chapter, does not have the word payable, and it always trips the students. Now, you see accounts payable, very similar to accounts receivable. So if you remember, accounts receivable, if the business provided services or sold goods, but they have not collected cash yet. Now, what is that for the other party? So the other party already received services or got the goods. They have not paid yet, but they owe the money. So that's kind of like cash that they will be paying. For now, it is recorded as accounts payable. We will be paying on that account. What is the difference between accounts payable and notes payable? We also have notes receivable too. Notes, it's an IOU, so it must be in writing, very similar to accounts payable, but it must be in writing. So we visited an attorney's office and we drafted a note, and both parties signed it. What about one more? The last one. The last one is probably the hardest one. It's owner's equity. It's owner's claims against the assets. It is also referred as residual equity or net assets. Net assets. So if I take assets, subtract my liabilities, I will have net assets or owner's equity remaining. And owner's equity has 4 parts to it. We'll discuss them in greater detail in a second. So the first 2 parts, you will have investment by the owner, and then also revenues. Those 2 will increase owner's equity, as opposed to drawings by the owner and expenses. Those 2 will decrease owner's equity. Let's take a closer look. What is that? Investments by the owner. Those are assets that the owner invested in the business. For example, I decided to start the business and I brought in cash, so that cash is my original capital. Or maybe I brought a desk from home and now that desk belonged to my business. Or maybe I bought a couch or brought a couch or whatnot. What are revenues? Revenues are gross increases in equity that results from either sale of goods or performance of services during the normal course of business. So again, investment by the owner, that's the owner's side, and this is business side when the business starts running. For example, if I'm providing tutoring services in accounting, when I provided my tutoring, that's my revenue for the business. Take a look on the other side. What are drawings? Drawings are opposite of investments. So I can invest into my company, or I can withdraw the capital, take it back out. So I can take my couch back, I can take my cash back, or I can take my table back home. And expenses cost of assets consumed or services used in the process of earning revenue. So I call them kind of suffering or past assets that are already consumed or used up. So for example, during my children's service, I had to use up some papers I was writing, or I had to pay rent because the services were outside of my home, or maybe I paid utilities, etc. So all those are expenses. We will be working with all these definitions for quite some time to make sure that you do understand every single one of them, because those are the ABCs of accounting.